An inheritance tax or estate tax is a levy paid by a person who inherits money or property, or a tax on the estate of a person who has died. In international tax law, there is a distinction between an estate tax and an inheritance tax. An estate tax is assessed on the assets of the deceased, while an inheritance tax is assessed on the legacies received by the beneficiaries of the estate. However, this distinction is not always respected in the language of tax laws. For example, the inheritance tax in the United Kingdom is a tax on the assets of the deceased, and is therefore, strictly speaking, an estate tax. For historical reasons, the term death duty is still used colloquially in the United Kingdom and some Commonwealth countries to refer to the estate tax. Varieties of inheritance and estate taxes: Belgium, droitste succession or successierechten. Collected at the federal level but distributed to the regional level. Bermuda, stamp duty. Brazil, imposto sobre transmissão ou herança. Collected at the state level. Brazilian Senate limited the maximum rate to 8%, but the average rate imposed by states is 4%. Czech Republic, Dordadica Finland, Perinter paragraph or Avskat, France, droitste succession, Germany. Erbschaftssteuer. Smaller bequests are exempt, that is a 20,000 to 500,000 depending on the family relation between the deceased and the beneficiary. Bequests larger than these values are taxed from 7% to 50%, depending on the family relationship between the deceased and the beneficiary and the size of the taxable amount. Ireland, inheritance tax. Italy, tassa di succession. Abolished in 2001, and re-established in 2006. A 1 million exemption on a bequest to a spouse or child, and a maximum rate of 8%. Japan, Suzakusei paragraph SHC paid as a national tax. The Netherlands, Successierecht NB. As per January 1, 2010, Successierecht has been abolished for the erfbelasting regime, and is replaced with erfbelasting with rates from 10% to 40% for brackets by amounts in separation. C. http www.Erfbelasting 2014 HTML. Switzerland has no national inheritance tax. Some cantons impose estate taxes or inheritance taxes. United Kingdom, see inheritance tax. United States, see estate tax. In the United States, some jurisdictions formerly had estate or inheritance taxes, but have abolished them. Australia abolished the federal estate tax in 1979, however, capital gains tax is levied on the sale of an asset or its transfer of ownership, and if this occurs upon the death of the owner it constitutes a crystallizing action, and capital gains tax becomes assessable. Austria abolished the Erbschaftssteuer in 2008. This tax had some of the features of the gift tax, which was abolished at the same time. Canada abolished inheritance tax in 1972. However, capital gains are 50% taxable and added to all other income of the deceased on their final return. Hong Kong abolished estate duty in 2006 for all deaths occurring on or after February 11, 2006. India had an estate tax from 1953 to 1985. Israel abolished inheritance tax in 1981. However, inherited assets are subject to a 20 to 45% capital gains tax upon their sale. Louisiana abolished inheritance tax in 2008, for deaths occurring on or after July 1, 2004. New Hampshire abolished state inheritance tax in 2003. Abolished surcharge on federal estate tax in 2005. New Zealand abolished estate duty in 1992. Norway abolished inheritance tax in 2014. Russia abolished inheritance tax in 2006. Singapore abolished estate tax in 2008, for deaths occurring on or after February 15, 2008. Sweden abolished inheritance tax in 2005. Utah abolished inheritance tax in 2005. Some jurisdictions have never levied any form of tax in the event of death, including Cayman Islands, Guernsey. Some states of the United States impose inheritance or estate taxes. Indiana, the spouse of a decedent is 100% exempt from paying inheritance tax. Parents, children, grandparents, grandchildren, and other lineal ancestors and lineal descendants of the decedent, as of July 1, 2012, are exempt from taxation on the first $250,000 of inheritance. Tax is on a sliding scale that starts at 1% to 10% of the net inheritance of each individual. More information may be obtained by referring to IH6, Indiana's inheritance tax instructions. Iowa, inheritance is exempt if passed to a surviving spouse, parents, or grandparents, or to children, grandchildren, or other lineal descendants. Other recipients are subject to inheritance tax, with rates varying depending on the relationship of the recipient to the deceased. Kentucky, the inheritance tax is a tax on a beneficiary's right to receive property from a decedent's estate. It is imposed as a percentage of the amount transferred to the beneficiary. Transfers to Class A relatives are exempt. Transfers to Class B relatives are taxable. Transfers to Class C recipients are taxable at a higher rate. Kentucky imposes an estate tax in addition to its inheritance tax. Maryland, Nebraska, New Jersey law puts inheritors into different groups, based on their family relationship to the deceased person. Class A beneficiaries are exempt from the inheritance tax. They include the deceased persona unregistered trademark S spouse, domestic partner, or civil union partner parent, grandparent, child, stepchild, grandchild or other lineal descendant of a child. Class B was deleted when New Jersey law changed. Class C includes the deceased persona unregistered trademark S, brother or sister, spouse or civil union partner of the deceased person's child, surviving spouse or civil union partner of the deceased person's child. The first $25,000 of property inherited by someone in Class C is not taxed. On amounts exceeding $25,000, the tax rates are 11% on the next $1,075,000, 13% on the next $300,000, 14% on the next $300,000, and 16% for anything over $1,700,000. Class D includes everyone else. There is no special exemption amount, and the applicable tax rates are 15% on the first $700,000, and 16% on anything over $700,000. Class E includes the state of New Jersey or any of its political subdivisions for public or charitable purposes, an educational institution, church, hospital, orphan asylum, public library, and some other non-profit agencies. These beneficiaries are exempt from inheritance tax. Oklahoma, Pennsylvania, inheritance tax is a flat tax on the value of the decedent's taxable estate as of the date of death, less allowable funeral and administrative expenses and debts of the decedent. Pennsylvania does not allow the 6-month after date of death alternate valuation method that is available at the federal level. Transfers to spouses exempt. Transfers to grandparents, parents, or lineal descendants are taxed at 4.5%. Transfers to siblings are taxed at 12%. Transfers to any other persons are taxed at 15%. Some assets are exempted, including life insurance proceeds. The inheritance tax is imposed on both residents and non-residents who owned real estate and tangible personal property in Pennsylvania at the time of their death. The Pennsylvania inheritance tax return must be filed within 9 months of the date of death. Tennessee, succession duty. Succession duty, in the English fiscal system, a tax placed on the gratuitous acquisition of property which passes on the death of any person, by means of a transfer from one person to another person. In order properly to understand the present state of the English law, it is necessary to describe shortly the state of affairs prior to the Finance Act 1894, an act which effected a considerable change in the duties payable and in the mode of assessment of those duties. The principal act which first imposed a succession duty in England was the Succession Duty Act 1853. By that act a duty varying from 1% to 10% according to the degree of consanguinity between the predecessor and successor was imposed upon every succession, which was defined as every past or future disposition of property by reason whereof any person has or shall become beneficially entitled to any property, or the income thereof, upon the death of any person dying after the time appointed for the commencement of this Act either immediately or after any interval either certainly or contingently, and either originally or by way of substitutive limitation and every devolution by law of any beneficial interest in property, or the income thereof, upon the death of any person dying after the time appointed for the commencement of this Act to any other person in possession or expectancy. The property which is liable to pay the duty is in realty or leasehold estate in the United Kingdom and personal to or euro not subject to legacy duty euro, which the beneficiary claims by virtue of English, Scottish or Irish law. Personalty in England bequeathed by a person domiciled abroad is not subject to succession duty. Successions of a husband or a wife, successions where the principal value is under £100, and individual successions under £20, are exempt from duty. Leasehold property and personalty directed to be converted into real estate are liable to succession, not to legacy duty. Special provision is made for the collection of duty in the cases of joint tenants and where the successor is also the predecessor. The duty is a first charge on property, but if the property be parted with before the duty is paid, the liability of the successor is transferred to the alienee. It is, therefore, usual in requisitions on title before conveyance, to demand for the protection of the purchaser the production of receipts for succession duty, as such receipts are an effectual protection notwithstanding any suppression or misstatement in the account on the footing of which the duty was assessed or any insufficiency of such assessment. The duty is by this Act directed to be assessed as follows: on personal property, if the successor takes a limited estate, the duty is assessed on the principal value of the annuity or yearly income estimated according to the period during which he is entitled to receive the annuity or yearly income, and the duty is payable in 4 yearly installments free from interest. If the successor takes absolutely, he pays in a lump sum duty on the principal value. On real property, the duty is payable in 8 half-yearly installments without interest on the capital value of an annuity equal to the annual value of the property. Various minor changes were made. By the Customs and Inland Revenue Act 1881, personal estates under 300 were exempted. By the Customs and Inland Revenue Act 1888, an additional 1% was charged on successions already paying 1% and an additional 11% on successions paying more than 1%. By the Customs and Inland Revenue Act 1889, an additional duty of 1% called estate duty was payable on successions over £10,000. The Finance Acts 1894 and 1909 effected large changes in the duties payable on death. As regards the succession duties, they enacted that payment of the estate duties thereby created should include payment of the additional duties mentioned above. Estates under £1,000 are exempted from payment of any succession duties. The succession duty payable under the Succession Duty Act 1853 was in all cases to be calculated according to the principal value of the property, that is its selling value, and those still payable by installments, interest at 3% is chargeable. The additional succession duties are still payable in cases where the estate duty is not charged, but such cases are of small importance and in practice are not as a rule charged. United States. The United States imposed a succession duty by the War Revenue Act of 1898 on all legacies or distributive shares of personal property exceeding $10,000. This was a tax on the privilege of succession. Devises or distributions of land were not affected by the law. The rate of duty ran from 75 cents on the $100 to $5 on the $100, if the legacy or share in question did not exceed $25,000. On those over that value, the rate was multiplied 11 times on estates up to $100,000, twofold on those from $100,000 to $200,000, 21 times on those from $500,000 to $1 million, and threefold for those exceeding $1 million. This statute was upheld as constitutional by the U.S. Supreme Court. Many of the states also impose succession duties, or transfer taxes. Generally, however, on collateral and remote successions. Sometimes progressive, according to the amount of the succession. The state duties generally touch real estate successions as well as those to personal property. If a citizen of State A owns registered bonds of a corporation chartered by State B, which he has put for safekeeping in a deposit vault in State C, his estate may thus have to pay 4 succession taxes, one to State A, to which he belongs and which, by legal fiction, is the seat of all his personal property. One to State B, for permitting the transfer of the bonds to the legacies on the books of the corporation. One to State C, for allowing them to be removed from the deposit vault for that purpose. And one to the United States. Other taxation applied to inheritance. In some jurisdictions, when assets are transferred by inheritance, any unrealized increase in the value of those assets is subject to capital gains tax, payable immediately. This applies in Canada, which has no inheritance tax. Where a jurisdiction has both capital gains tax and inheritance tax, it is usual to exempt inheritances from capital gains tax. In some jurisdictions, death gives rise to the local equivalent of gift tax. This was the model in the United Kingdom during the period before the introduction of inheritance tax in 1986, where estates were charged to a form of gift tax called capital transfer tax. Where a jurisdiction has both gift tax and inheritance tax, it is usual to exempt inheritances from gift tax. Also, it is common for inheritance taxes to share some features of gift taxes, by taxing some transfers which happen during the lifetime of the giver rather than on death. The United Kingdom, for example, subjects lifetime chargeable transfers to inheritance tax. Historical, ancient Rome, no inheritance tax is recorded for the Roman Republic, despite abundant evidence for testamentary law. The vicesima hereditarium was levied by Rome's first emperor, Augustus, in the last decade of his reign. The 5% tax applied only to inheritances received through a will, and close relatives were exempt from paying it, including the deceased's grandparents, parents, children, grandchildren, and siblings. The question of whether a spouse was exempt is complicated. From the late Republic on, husbands and wives kept their own property scrupulously separate, since a Roman woman remained part of her birth family and not under the legal control of her husband. Roman social values regarding marital devotion probably exempted a spouse as well. Estates below a certain value were also exempt from the tax, according to one source, but other evidence indicates that this was true only in the early years of Trajan's reign. The revenues from the tax went into a fund to pay military retirement benefits, along with those from a new sales tax, a 1% tax on goods sold at auction. The inheritance tax is extensively documented in sources pertaining to Roman law, inscriptions, and papyri. It was one of 3 major indirect taxes levied on Roman citizens in the provinces of the empire. See also, property tax, references.